Welcome to Fun with Annuities, where every single week I welcome a celebrity guest expert that can help you maximize Chapter 2 of your life. Listen, learn, laugh, and love every minute of the most unique financial podcast on the planet. Let's get to it. Welcome to Fun with Annuities. I'm your host, Stan, the Annuity Man, America's annuity agent, licensed in all 50 states. So glad that you're with us on all major podcast platforms. And for all you maniacs watching us on the Fun with Annuities YouTube channel, do you see how gorgeous these two people are? Yes, I'm including myself. But the other person that you're seeing out there is I've got a new nickname for him. I didn't even tell him. His name is Gary Baker, the Annuity Contractual Guaranteed Dream Maker. That's who he is. He is CEO, Grand Poobah of Canx. Why does that matter? Why is that important, Stan? Is because when you go to my site at theannuityman.com and you run quotes on my proprietary calculators, the man behind all those contractual guaranteed numbers, the man that's overseeing the hard work, doing all the coding, the man that gets the high five virtually is Gary Baker. Gary, thank you for joining us once again.
Stan, it's my pleasure once again.
Was that the best introduction you've ever had?
You know, that's like the longest nickname I ever got. You know, usually it's like Bake or, you know.
How about Gary Baker?
Touchdown Maker back in the early days.
Touchdown Maker. There you go. But it's Dream Maker. You know, the older you get, there's no functional things like touchdown. You know, it's Dream Maker. It's conceptual, Gary. But actually,
Touchdown with Annuities. There we go. That's the name of your new podcast.
With the new Score. Score with Canx. Yeah, send the royalty checks my way. Gary, there's a lot happening in the annuity world, and I know people are saying, you maniacs chose the annuity world for your career, and the answer is yes.
Mm-hmm.
We like pain. We like to explain why to people. But Gary, there's a lot going on in the group market. Can you explain, when we're talking about annuities in the group market, what does that mean?
Yeah, the dust is really flying there on a lot of activity. You know, at the end of the day, annuities have traditionally been more available to, the affluent, mass affluent, high net worth market, where there's a lot of need for, it's called, annuities are insurance, right? And and your financial planning becomes a little bit more complicated, and that's traditionally where annuities have been slotted in. But of course, through folks like yourself, you can really simplify that. Just get like a contractual guarantee for a fixed term or just a regular guaranteed income, like a pension. So you can, they're built to be simple, but they also built to be very complex. So, but in either case, you're giving up some liquidity for that insurance. So traditionally, it's been more available to that more mass affluent, high net worth market. What's cool now and what's happening is that back a few years, I would say maybe about 4 years now, Department of Labor, the government passed something called the Secure Act, which made it easier for employers to make decisions on making annuities available within a 401k plan. And what that really, it does a couple things. Number one is it makes annuities more available to a broader part of the market, the middle market, where people may not have had access to annuities before, and that's an important thing. But more importantly, it allows the employers some leeway to make those decisions, not take on a lot of that liability, and work with insurers to be able to build some type of option in the plan. Traditionally, income annuities, SPIAs, have always been available as a rollover option coming out of a 401k plan. When you retire, you'll talk to a distribution consultant and
immediate annuities for those out there. That's what that means. Single premium immediate annuities is SPIA.
Yeah. So, the distribution consultants say, hey, you're retiring. Do you want the lump sum? Do you want to roll over into an IRA, or do you want to roll over into an income annuity or a portion into an income annuity? And that's historically how they've been positioned up to this point. And the industry's tried to come up with some designs to put them inside of a 401k as an investment option, but they kind of, up until this point, it just was more of a retail product that was you would consider maybe more highly complex, where, folks may be not likely to make a decision on their own. They're going to need the help of an advisor, such as yourself. So I think what's happened now is a new wave of innovation, which is really cool. So it provides liquidity both during your savings and contributions into the annuity option, as well as liquidity afterwards. But they're being positioned as an asset within a set of investments, and more specifically, they're being positioned as a fixed asset within a target date fund. And typically in a 401k plan, the most common option available to you, and especially as a qualified default option, what that means is that when you enroll into a plan, if you don't make an investment decision, the company's just going to put you in the default option, which is usually a target date fund.
Right.
If you're retiring, say 20 years from now, they're going to put you in the 20, what's that? What I say? They'll put you in a 2044 fund, whatever that.
Right.
So, but what they've done now is they've taken the complexity away from the book cover. They kept it underneath the covers, and they'll manage a glide. If you keep contributing into that target date fund, there's a glide path that will gradually increase your allocation into this guaranteed income option within your target date fund. And then by the time you hit your retirement age in the 401k, you say, okay, dear participant, dear employee, here's how much you've accumulated in your own little personal pension bucket. Do you want to turn on that income guaranteed? Or again, do you want to take the lump sum out, or do you just want to liquidate it and put it in a regular rollover IRA? So it's really cool because it's really simplifying it. It's taking away the complexity. It's kind of bolted together so that it's a one size fit all type of a situation.
Okay.
But it can be mass marketed, and now you can make guaranteed income available to a much wider part of the population.
What's the underlying chassis of the product that's delivering the guaranteed income? What is that? Is that a variable? Is that an index? Is that a specific new product that no one's ever seen? Is it the new flexible annuity, the NFA, as I just coined it? What is it?
It's pretty much all the above. So depending upon the insurance company that's providing that option within the target date fund, it's either a variable annuity chassis with a income benefit, an index annuity chassis with an income benefit, or even a regular fixed or a MYGA chassis with an income benefit attached to it. So they're coming in different flavors, and there's different reasons why a plan's. Now, what's really cool also is that there's tools and help out there now that are providing training to plan consultants so they can sit down with the employer and say, well, what flavor of income do you want to provide to your employees in these things? Because each of those
I'm liking the word flavor, Gary, but it means nothing to me. Please tell me what flavor means.
Well, one flavor would be, do you want your guaranteed income just to be flat, for the lifetime? Or would you like your guaranteed income to maybe increase over time?
Potentially increase, right? Or do they have a guaranteed increase option as well?
There could be increases that
like a COLA.
You can have COLA. So
also living adjustment for people out there.
Yeah. There's some flavors that say your income can go up or can go down, but not below a certain amount. So it's really and I guess it really depends upon how they want to configure and embed that type of guarantee, or what type of decision the employer wants to make. Because I'll give you a good example. If you insert guaranteed income off an index chassis, right? You know that you're dealing with some guardrails. And if the S&P 500 does gangbusters and triples and quadruples, there's some limits.
Yeah, right? there's limitations on the upside regardless of what you hear.
Yeah. But on the flip side, their trade-off on that is it's not going to go, you got a guarantee. It's not going to go below a certain level. If you put on a variable chassis, your guardrails there's no guardrails, right? If the S&P quadruples, and if your in your equities and bond allocations are following something like, especially your equity allocation, you could do really well, and that income could increase almost through the roof. But there's probably a low likelihood of that actually happening. And on the flip side, your guarantee may be lower, if you, if it goes south on you. So there's a wider bandwidth with variable annuity. And again, you're making that decision so that your employees maybe have the opportunity to really do very, 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 very well in those
Got
tails, in those, certain situations or unlikely situations. On the other hand, if you're choosing an index chassis, at least you're putting some guardrails there, and you have you're not going to, you might have a chance to, on the average, outperform maybe something on the variable chassis. If you put on top of a MIGA chassis, you know what you're going to get, right? It's going to be pretty
got it.
flat, your traditional single premium immediate annuity. So it really depends upon how much risk. It's a risk and return. When you're an investment committee with as an
Sure.
employer, you're going to have some options for employees that are risky and some are not so risky. And then you're ultimately choosing your flavor or your risk element around guaranteed lifetime income. But in all cases, there is a guaranteed floor around that. It really depends upon, do you want to just have it stay flat on the
Sure.
guarantee, or you want some variability for the employees so they can maybe enjoy some upside?
Got it. We're talking to Gary Baker, CEO of Canx. He's the one that, if you go to my site and run quotes on our calculators, that's the company that provides the quotes, quoting all carriers, as I always say. But he is a thought leader and an innovator and a pioneer in where the annuity space and the industry is going, because any ideas that anyone has to implement something like he's talking about, they have to go through Gary, because they're going to be the ones that's going to actually provide the structure and the implementation to get this done, which kind of leads me to my next question on the group side. And just as a disclaimer, my company, the Annuity Man, is not in the group side as of yet. We are not there. Obviously, we're looking at it. But it's one of those things where it's a business decision. Right now, we're just straight direct to consumer. But in essence, my concern with all of this is, I look at annuities as commodity products, as you know. You quote them for the highest contractual guarantee, and you provide that for us. How are companies, investment boards of companies, overcoming the F word, in this case, fiduciary, of providing enough choices so they're not exposed for not showing people the highest contractual guarantee? How are they combating that? They meaning the companies that are actually providing these new choices.
Right. Well, there's a set of fiduciary practices that they have to follow. They do that today. So an employer will build a investment policy, that they'll create one that they will agree to follow. And that investment policy statement, states the investment objectives for the
Sure.
company and what they would provide. With these new options now, and maybe I think this is really kind of a tipping point here as far as the availability of these things. They're including now the annuity element into these investment policy statements at the employer level. So they're writing them to ensure that it includes this type of new investment, especially if it's going to be embedded in a target date fund.
Right.
And there's prudent practices that are spelled out, that guide the advisor, the plan advisor, along with the employer, to ensure that they make the right decision. Now, we participate and support something called the Lifetime Income Consortium.
Sure.
It's been launched by Broadridge. There's a number of member organizations that contribute to this, and mostly around a lot of these insurance carriers and others. And what they've done is help develop those set of prudent practices that an advisor would have to follow in guiding and providing consultation to the employer to make those decisions. So there's belts and suspenders and bubble wrap that have also
There needs to be, but all of this comes down to education. Not only education of the company, education of the board, education of the investment group, but the key part of the education, and what I pride myself on, is the actual end user. I'm sure there are steps being taken but that's where the concern comes in my case, is taking the person that's working, getting them on a lunch break and then trying to explain to them lifetime income choices.
Yeah.
Right.
Yeah. Yeah, exactly. And when it's embedded in the plan, that becomes even more important. And
Yeah,
I
definitely.
think historically, education has always played a big part in the purchasing of annuities, right? And it's
Hmm.
huge because you're trying to have the investor wrestle with the trade-off between their need or their desire for guaranteed income or a guaranteed return versus control their money or liquidity. And it's a spectrum. So that education kind of helps them navigate along that spectrum so they can make the right choice. What I will say though is, at the end of the day, a lot of people just want their money back out of the 401k, right? So what
Right.
we don't know is what's going to happen, what's the true experience when they hit 65 or whatever when they do retire, and do they want to let it ride with the 401k plan or the record keeper there, or do they want to bring it back into their own portfolio? And what I also believe is that, if you're able to save enough, your needs are more specific. So you may need to move out of a one size fits
Hmm.
all retirement option within a 401k. If you've been able to save at least a decent chunk to help you support your retirement, you're at that point where you need your own customized financial plan. That's probably where you're going to want to pull it into something with an advisor and then be able to, and that alone takes education, right? So I think your needs become a little bit more non one size fits all
Right.
uh, once you get to that point. So who knows? I mean, it's still early in the game as
It is.
far as
It is
the
really
traction
early.
on good
Yeah.
side, but I've always been a firm believer. At the end of the day, people want their money back. So
Well, it's kind of, the first thing that hit me was like, this is like the COVID shots. No one really knew what's going to happen at the end of the day. We're just kind of finding out what's happening with all the COVID shots that were taken.
yeah,
But my concern is most of the people that have 401ks, and we saw this last year during some hard economic times, people start cashing in the 401ks. There's a lot of redemptions of 401ks. I know
yeah,
that part of the filtering of companies that they're going to have to choose to implement this type of strategy are companies that can absorb that type of customer pivot, that have the administrative ability to push that paper and take care of the client. There's a lot involved here, that and you can't predict the future, and you can't predict how people are going to make their choices. But I think this is another choice along the line of qualified longevity annuity contracts that were put on the planet in 2014 by the IRS and Department of the Treasury, who designed it and implemented it. So people would start thinking about lifetime income other than Social Security. I think this is the next logical step. 401ks and defined contribution plans, which is what they're called, 457, 403bs, etc., um, are going to have to, they're going to have to offer these type of things, with the government encouraging them to do that, because I think it's a competitive. If I'm an employer, it's a competitive thing as well, and I'm trying to attract people. I think that should be a choice for lifetime income.
yeah.
Um, I think people are thinking about that more and more when it comes to chapter two. And with people out here like me pounding the table about, chapter two is all about you, they're starting to think it is all about income. It's all about income floor. Um, what are you advising some of these people that are going into this space, to look out for? What are your concerns, having been in the industry as long as me, forever, even though we look vibrant and young, of course? What are you telling them? What's your proactive advice for a lot of these people?
Well, I think what's interesting about the annuity industry in general is that the innovation or new designs that bring more value potentially, but depending upon the situation. But these new designs, they kind of outpace technology to support them. So even
Mhm.
though again, in a 401k situation, your typical record keeper, and you have some very large ones out there, right?
Yeah, definitely.
Empower, Fidelity, You know, a lot of
Huge.
these huge record keepers with millions
Yeah.
of participants, right? But there's a lot of that's the top, but you have a lot of mid-sized record keepers. Their administrative systems aren't used to dealing with tracking pension units
And annuity paperwork.
and
Annuity
annuity
paperwork.
paperwork. Yeah, and that's always been a big boulder in the road, right? So
Hmm.
so I think the industry still needs to catch up on the ability for record keepers to be able to account for this stuff next to investments. And there is solutions, and there are solutions out there. There are uh, uh, there are services that help record keepers translate the insurance aspects from the insurance company into the record keeper,
Sure.
kind of like a middleman, if you will.
I
Actually,
would think
some
that would be a growing market for the techies out there. Definitely.
yeah, exactly. So there's a lot of movement in that space so that they can connect, Mars with Venus,
No, absolutely.
So I think it's the operational challenges are still there, and there's the deployment of technology to really kind of overcome that. So there's still a lot of technology that has to be deployed in the regular or the traditional annuity market with advisors such as yourself.
Yeah,
So
annuity companies were kind of drug across the finish line during COVID to be more techy.
yeah,
I mean, they really were. They were forced to spend money on tech, and I think that was a good thing. If there was a silver lining out of the COVID thing, that was a good thing for the industry. But I would think this is the next hurdle and mountain for them to climb if they want to participate in this market. And obviously, if I own an annuity company out there, I want to be in this market because the numbers are staggering, I'm assuming.
yeah, yeah. Well, if you look at a traditional insurance company, with thousands of employees, you would think, oh, most of them are actuaries. The reality is over 50% of the headcount in any insurance company is pretty much the technology department. So it's a very technology
Really?
heavy. Yeah, it's a
How
very
about that?
technology heavy business already. And this just puts a little bit, they're dealing with life insurance and
They're
they're
doing it
insuring
all.
other things,
Yeah.
and they got real estate portfolios, and they're doing all sorts of stuff, right? And they've even ventured into their own brokerage, and
Hmm.
provide some of that support. So but yeah, no, there's already been a big spend, and this, around annuities, you have to, the spend keeps going, and just even during COVID, and even what we
Hmm.
chatted about before,
Yeah.
you would thought all that would have died down a little bit, just given that. But if anything, it's just been taken to a new level now as far as the investment into technology. And actually, in addition to the group market, and maybe not to segue here, but some of that technology investment and another new market or channel the insurance companies are trying to crack is the fee-based advisor.
Before we go there, and I do want to go there, what is your guesstimate on how many defined contribution plans have opened their offerings and choices to this annuity lifetime income choice percentage wise? Do you even have a gauge on what that number could possibly be? Won't hold you to that?
That's a good question. I think it's still relatively low. Now, that being said,
Like lower than 10% in your guess won't hold you to that?
that sounds about right.
Wow.
It may be going up a bit. The interesting thing is when an employer is shopping for a new 401k program for their business,
Hmm.
they'll put out a request for proposal, right?
Sure.
RFPs, like with any
Yeah.
type of business.
Hmm.
One of the On that RFP that the employer is putting out, they're always going to have, does your plan offer a guaranteed lifetime
So that's new.
income option? It's there. And the funny thing is, the other thing that's always on that RFP, is there a brokerage window available in your 401k plan? And of
Wow.
course, you check mark yes, yes. Now, on this brokerage window, and if you have your employer of like several hundred employees, what invariably happens is there's only one person that ends up investing in that brokerage window, which is the CEO. Right? So
Yeah, exactly.
and that's been kind of a common experience. So in this case, with guaranteed lifetime income being an option in RFP, it's there. They check the box. Good, I'll pick you. And then the question is where the rubber hits the road. Are they really ready to make the decision to put something in. Now, the Secure Act from 3, 4 years ago helps with that, but this is like moving a tanker. This just isn't. This
Yeah,
just take
this
off
is turning
overnight.
around this is turning around a cruise ship. You ever been on a cruise ship in a port and it takes them about 4 hours to do it? Yeah, this is going to be interesting to watch from a lot of cases, just because the vast majority of businesses, 80% or more, are small meaning 10 or less employees. So that's really the market, of which you then said, there's the technology issue there with those mid-level, because the big boys really don't want those type of plans. They take them. They want
Yeah,
the big ones. They want
yeah,
the big, the Fortune 500 company 401ks. There's a feeding frenzy for those because of the volume. But I think where this is going, the opportunity as an entrepreneur, but also that it's going to be hard, is that small employer.
yeah. Yeah, I know. And you see some of the states addressing this with state-based IRAs, even for
Mm-hmm.
small employers that aren't offering any type of retirement plan.
Yeah,
There's been some moderate success in a few states, but that's a tough road to plow, as well. And there are insurers and platforms that are built to take on those smaller plans. And but
sure.
with that, they're going to have to come up with more education
Yeah.
and support to be able to make that option more feasible for adoption, for those smaller plans.
And
So
for the smaller plan and the smaller plan administrator, they have to look at, liability and exposure and all those things as well. But
yeah,
I do think it's a growing market. I mean, we're probably less than 10% of the market. I would, before we pivot to the next topic, if you're out there and you're working, and you're still working for someone, I would just, and you don't know if these options are available to you, I'd lob a call into the administrator and just say, hey, do we have lifetime income options inside of our defined contribution plan? And if the answer is no, then your next answer is why not? I mean, your question is why not? Because I think this is going to be something that's going to be commonplace. I would say 10 years from now, Gary, when you still have dark hair and mine's gray, we'll say, okay, look at, there's 75% participation, or a big number, into the lifetime income component of a defined contribution plan. I think that is a positive for the country.
yeah,
And it will take a lot of pressure off of Social Security, in my opinion,
yeah.
because people will have different buckets to go from. So I like that. I like what I'm hearing, and glad that you're involved. If you're involved, I feel a lot more comfortable with it. Because your morals and ethics are in line with everyone out there, which is you're trying to do what's good for the end consumer, while helping the companies and the boards. Really, that's kind of the pyramid of what you are doing. You're saying, hey, I want to take care of the consumer, but here's how I think we can do it as an industry, which I always appreciate. You were mentioning the fee-based group, and these are your advisors that either fee-based or fee-only advisors, and under those platforms, masters of the universe, as I call them, and no pun intended. I just have some fun with them because I've been on that side of the ledger before.
Yep.
Tell me what's going on in that space that makes you optimistic.
Um, what's optimistic is that there is, in the same way that there's a lot of investment being made in the 401k market, there's a lot of investment being made to translate annuities for the fee-based advisor who has traditionally shunned annuities for a number of reasons.
Primarily because they can't charge fees on them.
Yeah, I mean, look, at the end of the day, if you're buying insurance,
Yeah,
it comes with a cost, and you're paying that either through a fee or a commission. At the end of the day, you end up at the same spot. Now, it just really, I think it's, from a price or fee perspective, generally over time, I would think it somewhat levels out. I think the bigger issue is the nature of the business of a fee-based advisor, as whether they're a master of the universe or not. They're all about ensuring that they can rebalance and repurpose your portfolio as you go through stages
true.
of your life.
True.
If they were to put some protection in annuity traditionally, then, they don't have control of those assets anymore. Even if you lock in a 7-year guarantee as a bond replacement on one type of an annuity, right?
Sure.
That's 7 years that fee-based advisor is not going to be able to touch that money. And so I think part of their value proposition is that, hey, I'm there for you, and I'm going to take care of this for you over the course of your financial life, and we'll readjust. And then as your needs and goals change, we'll modify your portfolio as need be. But you know, the annuity is not as moldable as what they're used to dealing with. And secondly, and you brought this up earlier in our conversation today, is the paperwork. It's horrendous in their perspective, right? They're used to
It's
making a trade after
unbelievable.
rebalancing a portfolio that afternoon.
That's
Oh, I
exactly
gotta wait
right.
2 3 weeks. It's like, this is crazy. You know what? I can do better in annuity. I'll be there and I'll make sure I get them we'll
Yeah,
take
you'll
care.
hear that from advisors say, you don't need an annuity. I can manage your money to create the annuity. Okay. But guarantees are guarantees. There's two reasons this is all happening in the fee-based space. Number one, the annuity companies want to tap into those fee-based advisors because they're managing a ton of money,
Yeah,
period.
yeah,
The reason that fee-based advisors are now taking their fingers off of their nose and not vomiting on the word annuity is the demographic tidal wave of 11,000 people turning 65 every single day and wanting guarantees with part of their portfolio. And we're at a point now that I don't think people, the fee-based or fee-only advisors can talk people out of that anymore,
yeah,
just because
yeah.
of the marketing that's going on. Someone like me with thousands of videos and 7 books and all these podcasts talking about guarantees, that's going to matriculate down to the ROI. And there's just so much that they can call me goofy and ugly, but they can't knock down my message. My message is
Right.
real. It's contractual guarantees. So what we have now is those two behemoths, the annuity companies wanting to get access to the managed money with the RIA type guys, and the RIA is going, oh my God, I think I'm going to really have to look at these annuities. And then now that that is kind of happening, what are the annuity companies showing to the advisors out there that's going to get them off go and have them eat their words that all annuities are bad? And they've been saying that for 2 decades.
Well, I think getting back to where the optimism here is, with the investment in technology, and we've been talking to a number of these firms where they're in the same way, right? There's this integration into the 401k, right? Turning this thing into an asset within the TDF. There's
TDF,
technology.
TDF,
Oh, I'm
TDF.
sorry, target date fund in the 401k plan
Thank you.
in the
Okay.
fee-based market, right? And as you mentioned, they're going after high net worth. They're going
Mm-hmm.
after these chunks of money that the boomers, here they come. Here comes
Mm-hmm.
the tail end of them. Um, there, there's technology that's continues to be developed that will help the fee-based advisor treat that annuity like another asset and be able to build portfolios and manage that portfolio. Now, there's some aspects of the operational stuff on the back end
Yeah.
with that as well, but it's trying to position the annuity as part of their existing practice, as opposed to making the fee-based advisor try to learn a new trick. It's like, no, just incorporate the annuity into the processes and their practices as what they do today, and make it more streamlined so that it can be there's allocations and it's part of efficient frontiers and those elements that fit nicely into the fee-based world. So that's, and at the end of the day, these are complex. When you get into the high net worth situation, annuities are configurable. They have so many different dials, and you're basically dialing up that insurance to
Right.
fit a specific need in the financial plan, whether that's estate planning or tax deferral, right? Or even juicing up a death benefit, or what you want to do for
Right.
other things, right?
Right.
One single annuity contract could probably do all those things, but you don't want it to do all those things. You don't want to you can buy the Swiss Army knife, but you only want to use one blade,
Then buy the blade. Buy the
right?
blade. No, I think I get asked a lot about this. RIAs and now the group. I'm getting some questions about the group stuff now. And my comment is you're going to love this correlation that I'm getting ready to make. RIAs are, they're getting to the point where I'd rather sell it than Stan get the business, because right now Stan's getting the business. So I mean, I got to look at it because I don't want him to buy a second Learjet. I don't have Learjet, but the way that I look at it, Gary, and for all the people out there going, Stan, what do you think about this? All these other people selling annuities, and aren't they going to encroach on your space? No. Here's the way I look at it. When you go buy a car, I want you to think about it. When you go buy a car, typically, when you go to a car dealership, there's like 7 other car dealerships side by side by side. Volvo, GM, whatever, Mercedes.
Right.
Why is that? It's because people are shopping, okay? People need cars, people are shopping. So what we're seeing here is a growth of an industry, organic growth. Organic meaning people want guarantees, people want lifetime income, people want principal protection, people want transfer of risk strategies. And so the group plans are starting to have it now. Great. The RIAs are starting to have it now. Great. And then you have the independents like me out here has been pounding the table saying, why isn't everybody looking at this? Now everyone's looking at it. I think it's great because at the end of the day, I want the consumer to have choices. And I have no problem with someone calling us up and saying, you know what, Stan, I've got my lifetime income covered in my group plan. Or Stan, I've got my lifetime income covered with my RIA that I've been doing business with 10 years. Great. Super. That's fantastic. I'm all for that because
Right.
people need guarantees. Kudos to Canx and your leadership as CEO of Canx of, I don't know, screaming into a hurricane and saying, you need to put this in there. If you don't put this in there, you're not going to have a competitive advantage as either a group plan 401k 403b or as a RIA. You can't keep saying, I hate all annuities. You can't keep saying that when everyone owns one, which is Social Security.
Right.
So what I'm happy about for you as a friend and been a long-term friend and watching your growth with Canix is you are in front of the demographic tidal wave. You're just trying to convince the grand poobahs of each industry that, hey, it's time to look. And it sounds
Right.
like to me, Gary, they're listening to you. They're going, yeah, you know what? We probably do need to look. Whereas I would say 5, 6, 7 years ago, they're like, nah, not right now. I mean, it's been interesting, right? To watch
Oh
it
yeah.
where annuity went from a curse word to like, I don't know, to now it's like, yeah, we probably need to look at that. I
Yeah.
give me and you full credit.
That's fine, but I think there's more out there that
We've
helping
been
out.
pounding the table for a long time, man.
Yeah, look, what we do as a business is that these are complex. These can be complex products,
Yes.
right? And what we're the reason why people call us is that they need a way to demystify and translate what each of these products does on a level playing field, so they know what how many how many features, how many dials, what they can do with each one in a much more simple way, because there's a lot of variation out there, and sometimes it's not like you can go with a mutual fund, right? You get your Morningstar report, and it's a 4-star, it's a 5-star, it's in this
Right.
box,
Right.
and okay, this is how I can deploy this particular mutual fund. That's tough to do when you're looking at so much variation in the market. And so what we try to do is kind of bring everything together, normalize it, and put it into a common framework where you can test it and
I
see
love
what
it.
you can do with it, and how it could fit into a broader portfolio.
So I think what Gary's really doing that's cool is he's providing those tools to where the analytical fee-based advisor can be analytical. It's not, don't take our word for it. Here are the here are the stats, etc. Here's what's happening. I got a huge question for you coming up, but the one question I wanted to ask just hit me is, in your mind, who's being more receptive now, the group people or the fee-based people, or is it they're kind of both leaning in an equal term?
Um, it's interesting. I think the group market is more of a top-down um, uh, situation
Is that good
where
or bad?
well, I don't say it's a beauty contest, but it's coming down from usually, I mean, the institutional market, and group market, it's driven by the DOL, and that the DOLs out there are saying, hey,
Department of Labor.
this is important. Yeah,
Yeah.
sorry about that. And there's a lot of committees and effort at the industry level, even leading up to the government really pushing this down. I
Got it.
think on the RIA, the fee-based market, it's the exact opposite. I think it's a bottoms up,
Well put.
hand-to-hand combat, to get.
Well put, one at a time. Even though there's some groupthink in RIA space, fee-based space, the reason that someone's a fee-based planner is because they think they can do it better.
Right.
So you almost have to go onesies to each person. That's the reason I kind of, call them masters of the universe. I used to be one a long time ago.
Yeah, and part of that hand-to-hand combat is that, a lot of those fee-based advisors are not licensed to sell life and health products. So
good point.
What some providers do, whether it's a advisory firm, or a support firm, or the actual insurer, they have what they call like OID, but what that really means is they have a partner with them that is
Right.
licensed, that partners with the fee-based advisor so they can transact the sale. And that specialist, if you will, that helps the fee-based advisor, will kind of guide the whole process from that perspective. And more importantly, they're licensed. So the fee-based advisor can partner with somebody who is licensed to make them
And once again, if you're listening as an entrepreneur, which I'm not, Gary, because I am an entrepreneur, but I'm an old entrepreneur. So, but if you're a young entrepreneur, he's given you some insights to where the opportunity lies. Because we're demographic tidal wave, fee-based planners that don't have insurance license. I mean, they're going to need some help going forward. One thing I wanted to do, because people listen to you, obviously we've gotten great comments when you've been on before. Just, wow, I didn't know how that worked. And you're kind of the wizard of the annuity Oz behind the curtain. Can you give us, without giving any type of, competitive stuff, tell us a little bit about Canx and who's in the building and what they're doing, and you're overseeing the IQ in that building. You're kind of a tech company, aren't you?
That's a good question. We keep asking ourselves that all the time. Well, look, let's face it. Any business today is a tech company, right? You can say, well, there's.
But aren't you guys more with every time I talk to you, you're hiring tech people, you're doing things. In essence, you're building platforms for people like myself to access, or fee-based planners to access, or group plans to access.
Yeah.
Aren't you Canx, the platform builder?
Well, I think the way I see us is more as like we're the electric company, the industry utility.
Wow, that's a great point. Yeah, that's a good way to look at it. You're the utility.
So, our platform, is stable, and it's not a speedboat.
No,
but
no.
it's robust, and because we focus a lot on making sure we get this stuff right. But I would say a lot of our investment in resources recently, and we continue to grow, is folks that translate these products. So whether that's on our consulting team, if we do it on a customized basis, or
translate meaning explain or implement.
So if an insurance company comes up with a new annuity type of product, right, in a particular category, they say, okay, we got to get that on the platform. Well, okay, let's pull it apart. Let's figure out what it does and retranslate it and put it into the industry utility platform so that it can be accessible, and so that you can then, with, through diligence, be able to put that up with other products, and then ensure that the advisors can be able to select, if that product is selected, that it's done within somewhat of a compliant way, right, within a broader utility. So in doing that, each insurance company may have their different glossary of terms and way they describe things. You translate that and say, oh, well, what they're really trying to do, it works this way. This feature actually does this.
Got it.
And now you know how to put it into an apples to apples platform so that you would still be able to show its value and how it is differentiated, but within a common language across. So I would say we're spending, some of our resources, in addition, technology is really on our consulting side, as well as operationally implementing products. There's new products being invented every day. So
Yeah, they're trying to get in front of
it's
those
not
baby
stale
boomers,
shelf, I'll
man.
tell you that.
No, no, I gotcha. The other way I want the listener and viewer to think about this is I want you to envision every life insurance company that issues annuities with a red phone on their desk. And it's got one line that can call one person. Gary has the red phone on the other line. So in other words, his company is working. There's no animosity between Canx and fill in the blank annuity company. They are working together on your behalf to provide you the products and show you the guarantees, and with some product, the potential past performance, so that you can make a good decision, or your fee-based or fee advisor can recommend something based on their analysis. That's who Gary is. Think of the red phone on his desk and the red phone at every CEO at every annuity company. That's the communication, and they are working together. I think the interesting part about the annuity industry, it is a competitive world, but not in between the carriers. I mean, they're trying to attract people to their product, but they kind of have to go through Gary and his organization to get there. That's my layman's version of you.
And the only thing I would add to that is that, we're more often than not, we're then the utility plugging into other applications that are presenting, and whether it's a financial planning application or
Right.
other types of front end. So again, that's where we're a utility. We're just plugging our PVC pipe behind your application and other applications, and there's different types of processes and research applications out there that people use and go to, but those applications don't have, we're able to do that translation and support whatever their mission is in financial planning.
As a consumer, you should feel very fortunate that Gary is behind all of this. As a group, or as a fee-based planner or fee-only planner, you should be happy that Gary's running the show. The only thing that I worry about Gary every single year, especially in the fall, is the Penn State Nittany Lions, of which Gary is a proud alum. But every year, Gary, and I've been to a game with Gary. He took me, tried to freeze my feet off at a Wisconsin game, and I'm now I'm now a Penn State follower. Gary, we'll kind of close on this, but how's next year looking for the Nittany Lions?
Well, the issue is that you want to be in the playoffs, right?
Yes.
It's good to be 1 through 4. We're always somewhere between 5 to 10. That's haven't been able to make that last step.
Maybe the expansion of the playoffs, Gary, will put the Nittany Lions with the fanciest helmets, with the fanciest helmets in the business.
12 teams in the playoffs sounds really good to me. But I will say, though, it is being in the South here now. And actually, I went to the Peach Bowl in Atlanta. We played Ole Miss, and
that didn't go well.
It means a whole lot more down here.
It does, man. It does. Gary is he runs numerous states, but right now he's in Charlotte, North Carolina, my old stomping grounds. And I'm envious a little bit just because of the barbecue that's accessible there. That's not accessible here in Florida. I'm not in Vegas right now. I'm in Florida. But Gary, any last words, mic drop moment for the consumers, listeners, and viewers on the annuity industry? Because I think this has been a great insight to where things are going, where the puck is headed, as they say, as Wayne Gretzky says, skate to where the puck's going to be, not behind the puck. Gary is doing that. Any last words?
I don't know. The only thing I can say is that at the end of the day, you're buying investment insurance, right? And so you can buy a very simple version of that, which is easy to understand, just like a bank CD, right?
Mm-hmm.
That's kind of like investment insurance too, but you probably get a better return with a fixed annuity.
Right.
Or you can buy more complex types of insurance through an annuity, investment
Mhm.
insurance. And with that, you need a trained profession.
Mhm.
You're not going to be able to do it yourself. And I think the real, the real trick is to, find an advisor that you trust
Mhm.
and you can work with. And then knowing that that advisor, either directly or through their team, um, has somebody that can configure the dials
Yep.
of that annuity to fit your specific plan. So
Yep.
it's, and annuity's not for everybody either, right? So you don't listen to the Fisher investment commercials,
We love them. Disclaimer: no, Nathan, great people. I mean, I ate at a great restaurant with Nathan, who is Ken's son. So I've got nothing against them. They're just, they're selling.
well, they're selling their own story. Like, I always say is, my intent when I talk to an advisor says, well, I don't sell that type of product, or I don't sell that type of product to my clients. To me, that's a red flag,
It
because if
is.
financial advisor, you should know all the tools available to you.
Correct.
And then depending upon your client specific situation, feel comfortable in
Right.
putting them in the right spot that's in their best interest and the right thing to do. If you have an advisor says, well, I don't sell this or that, I hate this or that,
Be careful.
I only sell this,
Be careful.
just run as far as you, just run away, run away.
I always tell people, yes, I'm Stan the annuity man. Yes, we only sell fixed annuities, but you need other things now. Come on now. I'm just a
Right.
specialist.
And you may
No,
not need an annuity either.
you might, oh, heck yeah. I mean, that's a
You don't
given.
need, no, annuities just for a specific purpose, right? And not everybody needs them. So
Exactly. Gary, the only last thing is, if you ever come through Florida or Vegas and don't call me, then I'm gonna track you down. I mean, it's
all right.
straight up. Gary and I are big music fans. We'll go into that the next podcast. We don't have time today, but I really
Okay.
appreciate you being on and giving us some insight on these two newer markets that most people don't know. And once again, two things, and let's close with this. If you have a group plan that you're involved in, you're still working, ask them if they have income options available. If not, they can get them. Number two, if you're with a fee type planner and they're not offering income type things, ask them why. They can get them. And the guy that's on the line with us now, Gary Baker, his company, Canx, who he's CEO of, they can provide this platform, or are providing those platforms to get you those contractual guarantees to combine with the other contractual guarantees that you have. So with that, Gary, thanks for joining us, and thanks for everyone joining the Fun with Annuities podcast on all major platforms and the Fun with Annuities YouTube channel. We'll see you next time.